All right, ladies and gentlemen, I hope you had a wonderful day. It was absolutely wild today. We started off the week and the month feeling very optimistic. There was good news out of NVDA and AMD about new chips. You had elections that were causing crazy reactions. Mexico's election and Mexico stocks, they ended up getting clobbered. But India, they had an election and things were looking good internationally. There wasn't any bad news about China. The market was up. Everybody was like, yeah, the PCE was actually good. We feel good and all of that. And then shortly thereafter, by the morning, Berkshire Hathaway stock, Berkshire.A, the one that closed at $629,000 a share. At one point today, it was trading as low as $185. It was down 99%. And on top of that, there was like 3 or 4 other companies that were big, even BRK.A. They had this weird glitch in halt and they went down. You even had Defend. This was the ETF, and literally like till the end of the day, it was pretty much clapped. But you had once again one of these pricing glitches in the morning that disrupted trading, but not really all too much. So we got a lot to talk about. I'm going to go over that. Everybody is chalking it up to a glitch. We have a couple more things we could bring up, but if you notice, I have MO here, and a lot of people ask, Josh, have you seen this before? Have you seen this before? And the fact of the matter is, just in this last week and a half, we have gotten about 3 different glitches, but other times in the past, this has occurred. Now, some of you may have been here. This is why I have MO, but some charts still reflect the last time this happened. And if you go 2 years ago, how many of you remember it was the beginning of 2023? After this, there was like Bank of Japan stuff at the end of 2022. Just a couple months before that, we were buying Meta. We should have bought NVIDIA, but you know, you had all this craziness going on, and then there was like random names that had big trades higher or lower. They got halted for a little bit. They said it was a glitch, and then everybody moved on, but you still see it on the chart. So I wanted to bring up that moment because this was the last noticeable part where I'm like, yeah, I do remember that, and it's still reflected on the chart. So what happened today with Berk and all of the other ones, we could add it to the list, but everything from low liquidity to what's going on with the rates and policy, I'm sure there's a lot of questions swirling. So we'll go over all of that. I have the recap. I have the plays. I have the questions, the keys, and a good lesson for you. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/thestackmarket. We will see you there in the morning. Run it, baby.
Walking to the couch, it's the 2020 last shit. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, before I get into the keys in writing, I want you to notice a couple of things about both the market and bonds. Like I'm telling you here in the morning, things were actually feeling pretty good. There wasn't really any bad news, especially after that crazy move on Friday. Oh yeah, we even had the GameStop news. Mr. Keith Gill buying and posting his positions, having $100 million in the stock. It's absolutely insane, but there was all of these things that happened, and we were actually trading good. If anything, the bonds were already up, and everything was chill pretty much until about 10 o'clock. 30 minutes into the day, we had the ISM manufacturing data, and believe it or not, even though it had a huge reaction on the markets, it did the opposite of the markets, and the bonds were up pre-market. After the data, they kept rocketing up. The dollar dropped, and then even gold went up, but then the market dumped, and before you knew it, the first hour or two of the market, it was dealing with all these glitches as everybody was like, wait, what's going on? It's not affecting everything. It's not affecting how things moved, but there was clearly something going on with the quotes once again. So that's the setup I want you to see, because you got to understand the bigger move on equities today. It came from that ISM manufacturing data. It was quote unquote bad, but it didn't necessarily give you a good reaction, and then we ended up going lower. Why I'm putting it like that? Because for the last 6 to maybe 12 months, this whole bad news, good news narrative, that has been a big driver. But now what we have noticed over the last 10 days, and a couple of people have brought this up, you are literally watching the NASDAQ go down while the bond yields are going down. This is somewhat of a new phenomenon because you would like to think, yeah, lower rates help some of these growth stocks and especially tech, even though they're a little bit more immune to rates. In general, lower rates has helped them out. And what has happened here over the last 10 days, the rates have been dropping again, but you are not watching the markets respond positively. So this is somewhat new. The other factor, even after the data and the fact that you're not getting this bad news, good news thing, a lot of people are starting to look around because on top of all of this, we are even waking up to the rate cut odds coming back. So we're going to hear from Powell in a couple of days here coming into next week. You do have the Fed blackout period, but this reaction and a lot of these macro effects kind of playing into it and people asking if there's something bigger going on. Well, you may hear this all summer or until something happens, but today was definitely fascinating. It's going to lead into the data that we get tomorrow. And now coming into key number 2, before we talk about that data, like I already said here, you had another halt and everybody's trying to describe what's going on. All I need you to understand, this is not new. And what I mean in the short term, you should keep your eyes out if this becomes a recurring trend. And this is some of the teething or growing pains of getting into T1. Ironically enough, nobody wants to say this is T1. People are bringing it up as a theory, but there is just no answer. Literally a week and a half ago, we switched to T1. That is the first time we have had a T+1 settlement since 100 years ago. And everyone's like, no, it's fine. It's going to be good. And even then, all of these little glitches are occurring. Nobody is really putting the blame just yet. But if we keep seeing this play out, I mean, there's only really 2 options. It's going to be nothing, or it's going to lead to a panic move, and then we get a little bit of a technical crisis, not necessarily a real one. So I'm not really jumping to any conclusions, unfortunately. I think that's going to have to play out with the summer, and we're going to feel like this. And like I said, go back to MO 2 years ago and a couple of other names. This isn't entirely brand new for the market, but doesn't mean it should be happening. And usually we should be getting a reason when it's all said and done. So watch out for that. But the final key coming into tomorrow now, you will be getting the JOLTS jobs openings. And after what we saw today, it can be very big. Not only is this whole week going to be all about jobs and getting that data and then guiding us into Powell, the thing you got to watch out for is that no matter what happens tomorrow, the data on Friday will trump it. But the thing about it is we need to watch for clues now. You just are getting this little streak of 10 days in the bonds and the NASDAQ and the rate cut odds. I would be watching for these broader clues and looking beyond just good or bad. You should be watching the bond yields on every duration and see how they are moving. Look at the rate cut odds, what happens with the dollar and other currencies. And if we still kind of watch some of these recent trends break and you get confirmation of that, that's literally what I've been telling you here. It is second half. We're going to watch things get confirmed, or some of those trades may break down, and then before you know it, you'll be right back to where you started at the beginning of the year. But now, the final thing I'll say, whether it is glitches or whatever is going on, man, the fact of the matter is, there is low liquidity. I've been telling you this, and the groundwork is being laid for it right now, whether we see the volatility strike right now or by the end of the summer. The point is, this low liquidity, it causes some very weird moves, and you have to be aware of it. That's why I go look at the chart over the last 2 days. Literally, Friday was absolutely insane, but even today was kind of crazy. You're seeing just big drawdowns down, and then you're making a huge move up. Gap up, sell off like 3/4 of it, and then you come right back up. Low liquidity, it doesn't take much to drive it down. It doesn't take much to bring it back up. So should low liquidity make you doubt the entire system and that everything's so vulnerable and it's going to crash? No. But you should be very sure with your movements. This should make you really ask, hey, if you want to make a trade during this period, Are you really like believing in the price that you're seeing and the idea and thesis, or are you just kind of hoping somebody's going to be there to scoop it at a higher price? If that's the case, low liquidity might punch you in the face a couple of times. So all in all, I think this has been the answer to a lot of things. Could it lead to something worse? Yes. Can it lead to the markets even melting up? Yes. So we just got to be sure with our moves, and I am sure over the next couple data sets, Powell, or whatever happens externally, we will find our answers. But now, let us get into the plays. So, right off the bat, I got a couple of different plays. I even made a long-term play for the long-term today, so I can't wait to share that with you. But play number one is GameStop, bro. And this is just wild, man. Not only did Roaring Kitty last night post his amount, he has $100 million in an option that expires in 3 weeks. That's insane. Even Citron was complaining about this. It's not the same, Kitty. I don't know. No way. I don't know. I thought I was going to do this one. It's not the same. It's a different kitty. It seems like he's a predator. But point is, everybody's talking about this. There's even a theory, because remember, apparently he only walked away with like $40 million after the first one. But some people are saying, just think about it. If he took $5 million, bought those short-dated options before he started tweeting, and then those went up like 48,000%, he might have been able to turn that $5 million into the amount that allows him here. Otherwise, some people are saying he's backed. I'm looking at you, Citron. It's overall wild, man. I'm telling you, this is kind of crazy. I'm surprised the stock didn't move as much, but then this is the real thing that's about to get nuts. So I'd watch out for this. I did grab a put play. I think I went for the next week or this week 1950 puts. I bought two of them for 30 just because I got this news early. Stock did drop. It was towards the end of the day, but there was a report that E-Trade may be trying to kick him off their platform. He's been posting his E-Trade screenshots, and there was a report that Morgan Stanley and E-Trade are saying what he's doing might be market manipulation, and it's borderline looking like they are trying to blacklist Mr. Roaring Kitty from the brokerages. I said this today. I was like, think about it, man. If one person and one big broker makes the excuse and they're like, yeah, well, it's borderline, messing with our compliance and all of that, and then all of them could reject it, and whether or not they allow them to transfer over or those contracts that expire in a couple weeks get shoved in purgatory like my account did when I was transferring over. It's a wild concept, but I think how this plays out, whether they kick him off, force him to sell, how he maneuvers it from here, this is definitely going to be one of the top things to watch this week alongside everything else with the data. So that is play number one. Coming into play number two, I finally made a trade on this. It's been a while. If you guys remember how long we even talked about it and what we were doing at the beginning of the year, but oil, I went with MCL. We'll go over the plays in a little bit, but quite simply, oil is moving all over the place with both war headlines from Russia and Ukraine down to Israel and Palestine, and then the OPEC headlines are extremely contradicting and going back and forth, and as a result, oil dropped down 4%. It's been a while since we saw one of these 4% days. Thought I would make a play. Do I still think oil could go down? Yes, it's also could go up a lot too. I think we're going to be getting a lot of this volatility. So if you like the movements, I'd keep your eyes out for it. It had a really big back down day after the last couple of days too. It's back below 80 and now like this mid 70 and like back to cheaper levels. It's literally the lowest it's been since February. That was like the last time we were trading this. The only problem is that it could get a lot worse. So especially with the future, even a small one, they could end up adding up, but oil could go as low as like $65 again. Right now it's at 75. That would be big on a future, so you got to watch out, but we'll cover that play in a little bit. That is play number two, and then finally, Humana. This play I'm still holding. I did make a nice average down after earnings, and that's been holding up, but I bought really high the first time, and the way I'm looking at it, we were talking even long-term, and I brought this one up, and the thing about it, it's at like 360. If you even remember about a quarter, 2 quarters ago, we made a flip on one of these options. We hit on it. It was around this level. I think this 360 level for Humana, it reminds me of CRM at that 235. It's either going to have a boom or bust, and hopefully, depending on if the market gets crazy, we could still see like an outperformer in healthcare. That could just be an added positive. So watch out for those three. Those are the main plays. As far as what I did today. All I did was the oil plays and then added to the long term. So in the morning, it was already down like 2 and some change. I said I'll go with 2 of the MCLs at 75.72, and then it dropped another 2% there, came back down to 74.68, another dollar lower, and I said I'll pick up 2 more, and that lowered my average to 75.19. At one point, I was green on the trade. I ended up closing down. I think I'm down like $400, but I'm down to swing this throughout the week, even buy a little bit more. This is kind of the beauty of going smaller. It's like I do have the budget to play one full one, and you've seen me do it, but with how some things are moving, low liquidity, I'll pay higher commissions by going more, but I could pretty much get to 1 if I really needed to. Otherwise, if I could work it with a small amount, it could do its thing. So plan on holding. If I do go green in the short run, I'll probably sell out. Otherwise, if it kind of meanders, I'm still going to be kind of keeping my eyes out for a Thursday, Friday pop, depending on what happens and what we hear from OPEC. So that was the first play. The only other one was Intel, baby. I finally did it. I do think this one could go lower, and that the beauty is I got another deposit here today. I have 2 deposits in the long term, so I used one of them for Intel. I still got a little bit cash there, whether we want to buy more dividends or not, but Intel, it meets the criteria. It's not at a premium. It's trading a lot lower. I've known about this for 10 years. I'll probably know about it in the next 10 years. I've used them, even though I'm on a Threadripper now. My other computer, I'll film on the i9 tomorrow for you then, okay? But I know about it, and at the same time, it's AI related. It's just dirt cheap out of any AI name. I mean, they are up there, and I think right now the market cap of ARM is bigger than Intel, so I'll take it, but it's still a $129 billion company. So I grabbed 100 shares on the big account, 10 on the small account, 10 on the Colt Sister. 30.24 was the price. We still got a little bit of cash if we want to buy more. Otherwise, we'll let it do its thing, and even though it pays a dividend, this didn't really help with the dividend goal, and I'm mad it's a new position instead of stacking up, but the beauty about it, we haven't really bought names that have too much growth in terms of share price, so maybe Intel is able to help out. And now I finally have some chip and AI exposure, albeit it may not be the highest quality of such exposure, but those were the main plays. And now, coming to the questions, baby. This one was a multiple part one. I got in my email, baby. Shout out to Jesse. I answered it, and they were asking me about real estate. And honestly, bro, I love you guys, and I'm very, very proud of y'all who have been taking both the long term and one saving and having a long term besides just the trading, and then to see you guys get into real estate and all this stuff. I'm always down to give you a helping hand. I don't need to make money on it and all of that. And I'll tell you how people are making money on it, or if you offer me a deal and I can't make money, I'll tell you exactly what I'm trying. You know what I'm saying? But I'm very proud, and I got a real estate question, and pretty much they were looking at a new build, and they were asking me all these questions about the property itself. I answered that in their email, but this one, and this is, I've just pasted my answer in the email here. I made sure I emailed them too, because last time I just did it live, you know, but I like this because I'm sure at one point a lot of you will deal with this. And they said, Josh, I'm just having to use the long term to do this deal. Should I just sell out of everything now so it's in my bank account when it's time to do it? Or should I wait because the house isn't ready till November? The money isn't liquid in my account, and I've never sold anything and transferred it back to the brokerage or from brokerage to the bank and checking account. So how long would that process take? I just got a lot of thoughts going on in my head. Jumbo, the bit's scary. And I'm excited. You're like, why are you getting so hyped at him being scared? Because these are great questions, and it definitely you're going through, you know, one of your biggest purchases. A home is usually one of the biggest purchases people make in their life. This stuff is intimidating, and it's good that you're actually asking and thinking about this rather than running away from it. And why I'm excited, because eventually, once you deal with this and you get, you know, out of the way, pop your house cherry, you know, am I allowed to say that? I don't know if that's aggressive. But the point is, the idea should be that once you get this out of the way, it's going to be a lot easier in the future to do. So as far as selling the long term, if you wanted to go and do it, I don't think now would be the worst idea. Now, here's the thing. His situation, he is buying a new build, and he already put down a deposit and is working with the lenders to get a specific discount. So in a weird way, if you already back out, you're going to lose money no matter what. So you're already locked in. The thing that I say when it comes down to, all right, you're buying a property, your long term is a good source of funds, you're going to be using that. I usually say get into escrow because things could happen. Maybe you back out, you think it's going to happen or not. Until you're in escrow, you're not really moving forward with the deal. And even in escrow, it could fall out. So like I say, just don't touch the long term until you know for certain the actual formal process to getting that property has now begun. So in this case, you're kind of locked in. So that's why I said maybe you could sell half now, sell the other half later. But the point is you are locked in. And if you're really going to make that decision, you could start preparing a little bit with the long term. Now, here's the other thing. If the amount in your long term right now is like exactly how much you need and things could change in the next couple of months, then sell it. If it moved up or down 10, 15, 20%, would that change your likelihood or prospects of getting the home? Yeah, then I would just sell out, call it a day, and secure the house. But then again, you can still fall out of getting that house, and then you'll just have to rebuild and go from there. But hopefully you didn't lose much. But like I'm saying, maybe half now, half later when you get there. That could be something, not a recommendation. Do not trade options, stock market, I think, yeah, okay, you get it. But now the next point is how long it takes to get that money from a trading account to your bank account. So maybe you've only deposited in your account and never pulled it out. If you sell something and you have all cash, the funds need to settle. Thankfully, you're on T+1 now, and it usually takes about like 3 to 5 days for the broker to ACH your money back to your checking savings account, wherever bank you have linked on your brokerage. But now this works with anything, getting money to your broker or getting money out of it. If you are worried about speed, you can always wire out of your account and tell your broker, say, hey, I need you to wire this to the account and wire it to my bank account so I get it instantly. You pay like a $30 or $50 fee, and you better make sure everything is correct. And don't wire it straight to escrow, because if you make a mistake on that, watch out too. There's oftentimes a lot of these escrow scams. So you got to be careful, a little bit more careful with wires. But the point is, you can get it done quickly with a wire in or out. Even sometimes if you need to get money into an account and you're worried about the speed, a wire is usually instant or within like 30 minutes. So I hope that helps. Congratulations on the property and keep it up, Chad. But now I got one more good question. After yesterday, they said, Josh, will the yield curve cause a recession? This even came up on that little CNBC economic thing, but the answer is yes and no. And a lot of times the thing or the mysterious nature of the yield curve, it has been used as this predictive but like hard to read predictive gauge of a recession. But quite simply, yes and no. It's a very loaded, weird question depending on how you're looking at it. But for almost a decade now, I have talked about this in my videos, and I've talked about the yield curve literally in like 2016 or even 2014, I believe. But I've talked about how people confuse the symptom with the disease. We say recession this. The stock market, it went down in '08. Why? Recession. Or the mortgage crisis caused a recession. But I think a recession is a cough. A cough is a symptom of something else. So what made the whole market go down? Was it a recession? No, I think there was something else that caused a recession as a symptom. There was something bigger at play. My view has always been that a recession gets mistaken as deflation. Now, you could go back and watch the videos I have on this. I sound a lot younger and everything too, but I've always said this. And even though we are about to reach the longest the yield curve has ever been inverted, the market's ripping, doing all of this, it's kind of something I expected. Obviously, not to the point where it's like, oh, this, but it should be mysterious, and that's why I've always said we have to look for the yield curve to uninvert. So the yield curve doesn't predict recessions, but I do think it's going to predict deflation, and that could lead to a recession. But more so, the thing about it and what we're talking about is the predictive power. And think about it. It is predictive. Look around. The yield curve inverted before the world went cuckoo. Go look at now, the first inversion in think about it, man. The world was already getting wild. This whole idea of short-term rates being higher than long-term rates is just showing you or kind of telling you about the environment that you're in. I would even argue that the yield curve told you things were going to get cuckoo before you actually ended up feeling it. And that's the same thing on the reverse. The yield curve is ahead of time and the timing is weird. I think the same thing would happen. And that's why we've talked about when the curve does uninvert and it normalizes, people may like that for a little bit, but if we do see your boy deflation come back up, not disinflation, but deflation, well, maybe it'll do its own predictive thing once again. But yes and no is the answer. I believe yes in a certain amount of situations, but like I'm saying, it's not about causing a recession. The recession is the symptom of a other bigger cause. Ta-da! But now, that's just all my opinion, you know what I'm saying? Let's get to a lesson, and if I do interject from reading from the book, I hope you know that is also opinion too. But Chatadonia, we got to finish up the whole enforcement WTO thing, and then the conclusion of international trade cooperation. So I'm very excited because we're about to finish 3 chapters of this book already, and as we start to move forward now, it's going to start heating up into some of the good stuff. We're going to talk society-centered stuff like we have in the past, and we're going to be talking about trade and then the currencies and all these other beautiful things. But so far, man, we have covered a lot. Big shout out if y'all have been hanging with me. And like I'm saying, though, as you're learning this, don't be afraid to think a little bit and theorize with how you could apply it to right here, right now. But getting into the lesson, we left off here yesterday. The ability of governments to use the WTO to enforce trade agreements is most clearly evident in the WTO's dispute settlement mechanism. The dispute settlement mechanism follows a standard procedure that was agreed to by all members of the WTO during the Uruguay round. A dispute is initiated when a government brings an alleged violation of WTO rules to the WTO dispute settlement body, the DSB, consisting of all WTO members. The DSB initially encourages the governments involved in the dispute to try and resolve the conflict through direct consultations. If such consultations are unsuccessful, the DSB creates a formal panel to investigate the complaint. This panel is typically composed of 3 experts in trade law who are selected by the DSB in consultation with the governments involved in the dispute. The panel reviews the evidence in the case, meets with the parties to the dispute and outside experts if necessary, and prepares a final report that it submits to the DSB. The DSB must accept the panel's final report unless all WTO members, including the government that initially brought the complaint, vote against its adoption. Both governments can appeal the panel's decision. If an appeal is requested, the DSB creates an appellate body composed of 3 to 5 people drawn from a list of 7 permanent members. The appellate body can uphold, reverse, or modify the panel's findings, conclusions, and recommendations. The appellate report is given to the DSP for approval, and as with the panel report, the DSP can reject the report only with the consent of all member governments. If at the end of this process it is determined that the disputed trade measure is inconsistent with WTO rules, the government must alter its policy to conform to the rules in question or compensate the injured parties. The entire dispute settlement process from initiation to appellate report is supposed to take no longer than 15 months. So it's going to give an example here, but this is pretty simple. It's kind of like even a court case, and it's saying, hey, 2 parties, they got to discuss it. Then you have these trade lawyers, they all come together, and they're like, yo, so what do you guys think? This is what we think. And then everybody pretty much has to agree it's fair. And if not, you could appeal it. But even in the appeal, if it comes up with something, everybody still kind of needs to agree on it. Or even the person who brought the dispute, sometimes they might like it, and then they'll say, okay, we won't do this, and then you either follow along or you pay the other person if you broke the rules. An ongoing dispute involving American cotton subsidies illustrates how governments use the dispute settlement mechanism to enforce compliance with trade agreements. The cotton subsidy case began in 2002. The Brazilian government complained to the WTO that subsidies paid by the U.S. government to American cotton farmers provided an advantage in global markets that harmed Brazil's cotton growers and violated WTO rules. The Bush administration defended the measures on the grounds that the subsidies represented a safety net that protected American cotton growers from volatile global commodity markets. Because the 2 governments could not settle the dispute through initial discussions, the WTO established a panel in early 2003. The panel found that American subsidies violated several WTO rules. In particular, the panel ruled that American cotton policy constituted an export subsidy and domestic production support that harmed Brazilian cotton growers. Although the United States appealed the ruling, the appellate panel upheld it. As a result, the United States modified its policy in an attempt to bring it in line with WTO obligation These changes failed to satisfy the Brazilian government. However, they requested that a WTO compliance panel evaluate whether the American adjustment brought the subsidies regime in line with WTO rules. The compliance panel sided with Brazil. It found that the U.S. policy change was insufficient, a finding upheld by the appellate panel. As a consequence, the WTO authorized Brazil to retaliate against the United States by imposing tariffs on imports of U.S. goods into Brazil as much as $823 million per year, the amount the American cotton policy cost Brazil. Brazil's threatened imposition of these new retaliatory tariffs induced the U.S. government to negotiate a less costly solution to the dispute. In April 2010, the two governments announced the results of these negotiations, arguing that cotton subsidies form part of its larger agriculture policy. The U.S. agreed to reform its cotton subsidies regime only as part of the 2012 Farm Bill. Second, until the subsidies regime is reformed, the United States agreed to pay Brazil $147 million per year for capacity building and technical improvement in Brazilian agribusiness. In exchange, Brazil agreed not to impose retaliatory tariffs against U.S. goods, services, or intellectual property. In other words, Brazil accepted current American policy, even though it violated WTO rules, and the U.S. agreed to compensate Brazil for doing so. So hopefully that makes sense too, and kind of like we were talking about in bargaining a little bit earlier, and how there's different outcomes and, again, suboptimal, and trying to like go a little bit on the curve there. You got to think about it. In this case, it took 12 years to actually make a change, but in the meantime, they're like, hey, you let us keep doing it, and then we'll make a change in like a decade, and then we'll give you $140 million a year so that you don't hit us with $800 million a year. Ta-da! But again, it still violated WTO rules, but the whole point this is saying is that enforcement mechanism made it to where they have to work together at least with something, and somebody gets something, you give and you get, rather than just kind of like, okay, well, anarchist state, we don't have to do this, and then now these deals don't mean anything, and then hibbity-bobbity-boo. But continuing, the dispute finally ended in 2014 as a result of two developments. The most important was that of the U.S. government restructured its cotton support in the 2014 Farm Bill. Congress removed price supports and direct income supports for cotton producers. In their place, Congress enacted an insurance program that growers must pay into in order to qualify for payments. Moreover, the insurance fund compensated farmers when they suffered a loss rather than providing benefits to ensure a given income. These changes brought U.S. policy in conformity with the WTO rules. Second, once the 2014 Farm Bill was in place, Brazil offered and negotiate a final agreement that would end the dispute. In this agreement, announced October 1st, 2014, Brazil agreed to drop the cotton dispute and refrain from initiating any new WTO actions in return for U.S. commitment to the terms of the Farm Bill and a one-time payment to Brazil Cotton Institute of $300 million. So before we continue, I want you guys to notice something. Farm Bill 2014, go back to the Sal video. This is very important. You got to think about it, because this whole thing, and like a lot of what our commodity trades, at least with agriculture, have been dictated by in the last decade, this Farm Bill. And if you really think about it, this whole insurance to farmers, this is relatively new. And believe it or not, by implementing this insurance thing for our farmers and removing some of the other subsidies there, this brought you conformity with the WTO rules, and then a disagreement with Brazil from like 12 years ago. At the time, at this point, it's been almost 20 years. Ta-da! Isn't that right? Wild? But continuing, the cotton case illustrates how governments can use tit-for-tat strategies to enforce trade agreements. An alleged defection by the United States prompted a WTO investigation. The investigation indicated that U.S. policy violated WTO rules, and when the U.S. failed to bring its policies in line with its obligations, Brazil was allowed to retaliate by withdrawing concessions it had made previously to the Americans. In the language of the iterated prisoner's dilemma, the United States defected, and Brazil, playing a tit-for-tat strategy, defected in response. Moreover, Brazilian retaliation came only after the WTO had determined that it was justified and the scale of the retaliation was proportionate to the injury suffered. Although the WTO's dispute resolution mechanism focuses our attention on a legalistic version of tit-for-tat, it allows us to see in a very detailed way how the WTO can promote trade cooperation by helping governments enforce trade agreements. The cotton dispute is especially interesting as an illustration of how, even arguably, arguably the most powerful WTO members can be made to bring their policies into accordance within its WTO obligations. The WTO thus helps governments gain the assurances they need in order to conclude the trade agreements required to capture the gains from trade. The WTO provides the assurance by allowing governments to monitor the behavior of their trade partners and to enforce the trade agreements that they reach. By doing so, the WTO enables societies to capture the welfare gains the trade provides. In the absence of the WTO or an institution that performs similar functions, it is unlikely that governments would be able to reach the agreements required to liberalize trade. Each society, and thus the world as a whole, would be poorer as a result. Conclusion of the chapter. The WTO exists, therefore, because it facilitates international cooperation, thereby enabling societies to capture the welfare gains made available from trade. Trade raises social welfare by enabling consumers to enjoy a higher level of utility than they would if they consumed only goods produced at home. The principle of comparative advantage tells us that these welfare gains do not require a country to have an absolute advantage in anything. As long as a country is better at doing some things than others, it gains by specializing in what it does relatively well and trading for everything else. Politics, however, makes it difficult for societies to realize these gains from trade. For reasons we examine in greater detail in the next chapter, governments often neglect consumer interest in favor of producer interests. Consequently, governments can capture the gains from trade only by negotiating agreements in which they exchange market access commitments. In such bargaining, governments strive to gain access to foreign markets for their comparatively advantaged industries in exchange for granting access to the markets in their comparatively disadvantaged industries. Consequently, governments employ bargaining power in an attempt to gain maximum access in exchange for minimal concessions. By providing a forum for bargaining, the WTO enables governments to liberalize trade more than they would be willing to do unilaterally. Yet, concluding trade agreements is also complicated by the enforcement problem. Governments must believe that cooperation on their part will be reciprocated by cooperation from their partners. They must believe that their partners will not take advantage of them, and as the prisoner's dilemma highlights, unless such assurances are provided, governments have little incentive to cooperate. The international trade system lacks the equivalent of a state to enforce agreement, and thus governments face a pervasive enforcement problem when they try to cooperate for mutual gain. Consequently, it is difficult for governments to conclude mutually beneficial agreements, and as a result, societies have lower standards of living. The WTO helps governments solve the enforcement problem by enabling governments to feel reasonably secure that their partners will comply within the agreements that they enter. The WTO provides the assurances necessary to achieve cooperation. Strictly speaking, the WTO is not an international equivalent of a state because the WTO does not have authority or the capacity to punish governments that fail to comply with trade agreements. Instead, the WTO facilitates international cooperation by providing an infrastructure that allows governments to enforce agreements themselves, by providing a set of mutually agreed rules, by helping governments monitor the extent to which their partners comply with the rules, and by providing a dispute settlement mechanism that helps governments resolve these issues of compliance that do arise. The WTO enables governments to enforce effectively the trade agreements that they reach. The WTO thus provides enough assurance that all governments will live up to the agreements as they enter into, and that no government will be able to take advantage of the other. By providing this infrastructure, the WTO enables governments to conclude the trade agreements necessary to capture welfare gains from trade. Brought to you by Klaus Schwab. What? No, but that's what it kind of sounds like. Again, WTO, it saves us, but like, hopefully you guys get it. My opinion, this is how a lot of things are. It's kind of like how money works in the dollar. The WTO can't do jack, but the fact is it offers these things that makes it relevant. And like we've said from the beginning, without this, like, again, you wouldn't be able to do a lot of things, but the fact of participation and people kind of being involved, and you got to think about it. The main example there that it was just showing you with America, it even shows to the times that, like, we've had to crater to it. I would even argue as of now, we probably give in a little bit more than we would have in the past. So all in all, it's setting up a lot of things, but, you know, the next chapter we're going to talk about now is like, yo, how come governments still do some weird things now? What's it based off politically, economy, and how does it benefit other people, whether it's consumers, producers, and all of that good stuff. But Chad, I hope you enjoyed it once again. That is all I have for you. If you have any questions, let me know. Shoot me an email, any of that good stuff. But That is your watch list, ladies and gentlemen. Make sure Hydrate Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, let the burden push you to where you need to go. Don't run away because of a burden. Run towards it. Shoot the arrow. You miss, you run towards the arrow, baby. But Chad, I love you. Drink that water. Stay hydrated, healthy, all that good stuff. Shout out to Noah too, bro. He got the tap, bro. I don't know if y'all saw. We have another one, Chadadonia. We have another one. Let's go, baby. Horn.